Okay, let's dive in. Imagine turning, well, just raw data into a potentially huge opportunity, maybe even millions.
Yeah.
That's kind of what we're digging into today, looking at these real-world financial documents you shared. We've got this executive summary for a Wolfcamp oil and gas prospect in the Nebraska Basin, and also an exploration agreement for Purdy Oil, LLC, also in Nebraska.
Hmm.
So our goal here is really to unpack the crucial bits, the financial side, the big picture for potential investors,
Yeah.
without getting lost in the weeds, those super technical stuff.
Yeah, and what's interesting, I think, is how these two documents give us different angles on, well, potentially similar geology. You have the broad view, this possibly massive discovery in a place that hasn't been explored much, and then you contrast that with a very specific, detailed look at one particular investment deal, both Nebraska Basin, both Wolfcamp Formation, but yeah, different scales, different stages.
Exactly. So let's start with that wider lens then, the Executive Summary Wolfcamp 1.pdf.
Hmm.
It paints this picture, calls it a Tier 1 unconventional discovery, even compares it to the Permian Basin. Now, for people maybe not steeped in this, the Permian is, well, it's huge for oil. So when they say Tier 1, what does that really signal? What kind of potential are we talking about?
Generally, tier one in oil and gas, it's just they believe it's got really high quality rock, rich in oil and gas, good characteristics for actually getting it out. These areas, they usually have the potential for pretty strong economic returns because there's just a lot of resource there and it's accessible. And that Permian comparison, that's significant. The Permian's been a powerhouse for decades, so it implies or hopes that Nebraska could have that kind of longevity.
Yeah, that helps frame it. Now, the summary, it throws out some really, really big numbers for the resources they think are there. 88 million barrels of oil, 1.8 TCF of natural gas. Let's put that into perspective. At, say, $50 oil, that oil alone is over $1 billion. The gas, maybe close to $5 billion. But then they add something else, something really interesting. 6.593 TCF of white hydrogen in place. What exactly is white hydrogen, and why mention it?
Right. So white hydrogen is basically naturally occurring hydrogen, found underground, not manufactured like most hydrogen we use today. The significance, well, it's potentially a very clean energy source, lower carbon footprint. So finding a lot of it naturally, that adds this whole future energy angle to the basin beyond just oil and gas. Though they do say it's, quote, reserved for future development. So exciting, yeah, but maybe not the immediate focus.
Gotcha. More like a potential bonus down the road. Okay, sticking with oil and gas for now. The production forecasts, they look pretty good on paper. They talk about maybe 450 BOEPD initially from a vertical well. That's what, about $22,750 a day. For those of us not speaking fluent oil field, what's BOEPD? Why is that the metric?
Yeah. BOEPD is barrels of oil equivalent per day. It's just a standard way the industry combines oil and gas production into one number based on energy content. Makes it easier to compare wells or projects that produce both. So 450 BOEPD is the combined value, essentially, of the oil and gas coming out each day from that first well type.
Right, oil equivalent, makes sense. And they project a horizontal well could average more like 675 BOEPD,
Yeah.
about $34,000 a day. And then they scale it up. If they drill 12 horizontal wells, peak output might hit 8,100 BOEPD. That's potentially, what, almost $410,000 a day in gross revenue, assuming a 65% oil cut. What's that oil cut part mean?
The oil cut is just the percentage of the liquids coming out of the well that is actually crude oil. So in this case, they're estimating 65% oil. The other 35% would be things like natural gas liquids, maybe condensate. It matters for the money side, obviously, because oil and gas often sell at different prices.
Got it. Okay. Now, something that really jumped out at me was the infrastructure piece. They mentioned 3 major gas pipelines within a mile, crude oil pipeline access nearby, close to refineries in Colorado. That sounds like a massive advantage, right? Getting the product out easily.
Oh, absolutely. Infrastructure access is, well, it's huge in any resource play. It means you don't have to spend a fortune building your own pipelines right away. Saves a lot of time, a lot of money, gets the oil and gas to market faster, more efficiently. And yeah, being close to refineries helps too.
Right.
Streamlines things.
The summary also says a lead well is already drilled, down to about 11,000 feet, and it's cased and logged, hit the targets. What does cased and logged tell us, practically speaking? Where are they in the process?
Cased means they've put steel pipe in the wellbore, cemented it, gives it strength, stops it collapsing. Logged means they ran tools down the hole to measure things, check the rock formations, confirm there's oil or gas there. So doing both and hitting the targets, it indicates they've confirmed the resources there, at least at that spot, and they have a stable well ready for the next step, which is completion and production.
And legally, it sounds like they're set up, fully bonded, permitted with the state commission, lease agreement, perfected title rights. What exactly do perfected title rights guarantee an investor?
Um, Essentially, it means the company has clear, documented legal ownership of the rights to extract the minerals under that land. It seriously reduces the risk of someone else showing up later and claiming they own it, avoids legal fights over ownership, more certainty for investors.
Okay, so for someone thinking about investing, the document mentions equity or JV participation, and they're offering a 25% recovery interest for the first investors, the first-in capital partners. The potential returns look, well, pretty impressive. Year one cash flow, just for that 25% share, estimated at $37.5 million. And a modeled ROI over 7.9 times capital for the whole project life. Those are big numbers. What's the caveat?
Well, the caveat is always that these are projections. Attractive, yes, but they're based on assumptions. Assumptions about future oil prices, like that $50 number production rates, how much it costs to operate. Real results can, and often do, vary. Market prices change. Wells don't always perform exactly as modeled. So, thorough due diligence, really understanding those assumptions is critical.
Right. Always read the fine print or create it. It's also interesting they use this proprietary tech, SNMR satellite nuclear magnetic resonance,
Yeah.
to find these spots. How's that different from, say, traditional seismic surveys?
Traditional seismic uses sound waves, basically, to map underground structures. It's been the workhorse for decades. SNMR is different. It uses electromagnetic fields, trying to directly detect fluids like oil and water and their properties. It can give you different information, maybe a more direct clue about the fluids themselves. And being proprietary, well, it might give them an edge maybe others don't have.
And lastly, on this summary, it notes drilling and bonding was done back in late 2022. And importantly, previous financing delays are resolved. Suggests maybe the project's got momentum now.
Yeah, that could signal that. Getting past earlier funding problems, having that first well drilled, it can reduce that very early stage risk, makes it seem more likely to actually move into development and production.
All right, so that's the kind of 30,000-foot view of the Nebraska Basin Wolfcamp play. Big potential.
Yeah.
Now let's zoom right in. Let's look at this. Global Capital Commodities, LLC, GCC, Oil Exploration Agreement.pdf. This details a specific deal with Purdy Oil, LLC, down in Kimball County, Nebraska. It also mentions Wolfcamp, but it feels much more immediate, more defined.
That's right. This Purdy Oil agreement, it gives you the ground level view of one specific transaction, much more detail. It lays out this deal between Purdy and a partner, doesn't name them, but someone investing, targeting Wolfcamp, yes, but also JSAN and Admire formations, and it gets very specific about the money up front. The partner needs to wire $2.7 million right away upon signing.
Okay, $2.7 million. And that's specifically to complete an existing well, the Purdy Farms, #1, across those different zones. They've got this phased approach laid out, phase I and II together, completing the well and drilling or testing for hydrogen, are budgeted at that same $2.7 million. So it seems like that initial chunk of cash is meant to get that first well flowing and also take a look at the hydrogen potential there.
Exactly. That structure, it lets the investor, the partner, see some near-term action, get that existing wellbore working, but it also lets them participate right away in checking out if that hydrogen potential is real in this specific spot.
And drilling and testing for hydrogen, phase 2, has its own cost estimate within that $315,000 to maybe $554,000. Then phase 3 gets bigger. Drilling a new well, Purdy Farms #2, plus potential horizontal legs off these wells. The new well is tagged at $3.5 million plus other costs. Each horizontal bid is another $1.7 million. And if they go for hydrogen horizontals, could be way more, $4 million to $10 million per well. This gives a much clearer roadmap of potential future costs.
That detailed cost breakdown by phase, that's really valuable for the partner. It gives transparency. You can see the potential capital needed at each decision point as the project unfolds, allows for more informed choices later on.
Okay, let's talk returns for the partner in this deal. They get 50% of the cash flow before something called payout, and then it drops to 25% after payout. How is payout defined here? What's the trigger?
Payout, in this context, it's defined as the point when the partner gets back 100% of the money they put in to complete that specific well. That includes their share of the operating costs, too, not just the initial drilling and completion money. It's a pretty common structure, Gives the investor a faster return initially, then settles into a longer-term profit share.
Right. And the agreement also explains how the partner earns their working interest. It's based on costs divided by 25 per well. And then there are royalties, 12.5% to the landowner, plus another 12.5% overriding royalty, it's 25% off the top, leaving a 75% net revenue interest, or NRI. Okay, for someone new to this, quick difference, working interest versus net revenue interest.
Sure. Working interest, think of that as your ownership slice of the well itself. the owner who pays the bills for drilling, operating, etc. That formula tells you how the partner earns that slice based on their investment. Net revenue interest, the NRI, that's the percentage of the actual money, the revenue from selling the oil and gas that the working interest owner receives after all the royalties the landowners cut, the overriding royalty have been paid out. So working interest pays the costs. Net revenue interest is your share of the income.
Okay, helpful distinction, thanks. The timeline here is interesting too. Lease secured late 2021, first well drilled sometime in 2022. This agreement is 2024. So Phase I is basically finishing that well they already started.
Yep. The project already has some history, some money already spent on that first well bore. This agreement is focused on taking that existing asset and getting it producing, and then looking at what's next.
Now, and this is where it gets maybe a bit more complicated. The agreement, it gives us a peek into Porty Oil's own situation. They're involved in lawsuits as the plaintiff, trying to get some land and mineral rights worth maybe $750K. They had some drilling rigs too. But they're also defending claims from vendors they haven't paid, looks like almost $900K total, though they hope to settle for less, maybe $500. Plus, legal cost estimates. It actually says some of that initial $2.7 million investment is earmarked for legal and debt settlement. What does that kind of information mean for the partner?
Well, it highlights why due diligence is so important. The geology might look good, but you have to understand the financial health and any legal baggage of your operating partner. These kinds of liabilities, they could potentially eat into the project's cash flow, or worse, derail things. The fact the budget includes money for this stuff suggests they're aware of it, they factored it in, but an investor would definitely want to dig into the details, understand the potential impact.
Yeah, definitely. Interestingly, the partner gets the right to audit Purdy's books. Though they have to pay for the audit themselves, Purdy provides unaudited numbers. That audit right, it feels like a pretty crucial protection for the investor.
Oh, absolutely. That right to audit the books is a key safeguard. It lets the partner independently verify where the money's going, check the revenues and expenses, ensure some accountability, transparency.
And looking forward, the partner also gets a first shot, or right of first refusal, on Purdy's next well within 5 miles. That could be valuable if this first one works out well.
That right of first refusal, it gives the partner a strategic advantage, potentially. If the first project is a success, they get the first chance to expand their investment in the area, leveraging what they've already learned.
And a really key point, maybe for some listeners thinking about these kinds of private deals, the partner must be an accredited investor. What does that mean generally?
Basically, the accredited investor status, it's defined by securities regulators like the SEC in the U.S. It usually means individuals or entities have to meet certain income or net worth thresholds. The idea behind these rules is to try and ensure that investors in these types of potentially higher risk, less regulated private offerings have the financial means and sophistication to understand the risks and, frankly, to potentially lose their investment without it being catastrophic.
Right, it's a threshold for participating.
Yeah.
Okay, one last thing from this agreement. It mentions a projected first month income for the venture of $90 million USD. That seems incredibly high for a first month of operations. What should an investor make of a projection like that?
Yeah, a $90 million first month projection. That definitely warrants very close scrutiny, extreme scrutiny probably. An investor would need to dig deep into how they arrived at that number. What production rate are they assuming? What oil and gas prices? Is that gross revenue before costs and royalties or net income? It seems unusually high for an initial period. You'd absolutely need to verify the realism of that kind of projection through due diligence.
Okay, so let's pull back a bit and put these two side by side. The big Wolfcamp summary and this specific Purdy Oil deal. What are the main takeaways for someone trying to understand these opportunities? You've got huge scale potential versus a defined near-term investment.
That's the core contrast, really. The Wolfcamp summary paints this picture of a massive basin-scale opportunity. High potential, but likely needs big investment, longer timeline, more exploration risk perhaps, but bigger prize if it works. The Purdy Oil agreement is much more contained. Defined cost, specific, shorter timeline to potential cash flow from Phase I. But it comes with those operator-specific risks we talked about, the financial situation, the legal stuff.
And the hydrogen element is in both, but treated differently. Big picture, future potential in the first one.
Right, more speculative, reserved for later in the basin summary.
Whereas in the Purdy deal, there's an actual budget line item to test for it right away in phase 2.
Exactly. It shows different stages of thinking about hydrogen. One acknowledges it, the other is taking concrete steps, albeit small ones, to actually evaluate it on their specific acreage.
And seeing the level of detail in the Purdy agreement, the costs, the payout structure, the legal disclosures, it really hammers home how crucial that deep dive due diligence is.
For sure, the Purdy document is a real-world example of the kind of complexity you encounter. You have to analyze every piece, the geology, the engineering, the financials, the legal, to really get the picture.
So risk versus reward.
Hmm.
The big Wolfcamp play offers that potentially massive upside, that 7.9x ROI they modeled, but it's a longer game, maybe more uncertainties.
A higher potential reward often comes with higher initial risk and definitely a longer time horizon, yeah.
The Purdy deal might get you cash flow sooner if the well works, but you're taking on risks tied directly to that specific operator and their situation.
It's a different risk profile. Investors really need to match the opportunity to their own risk tolerance, their investment timeline, what they're comfortable with.
And finally, that tech piece the SNMR mentioned in the Wolfcamp summary, it's just a reminder that technology keeps pushing the boundaries and finding resources.
Absolutely. New tech can unlock plays that weren't viable before, maybe reduce some of the guesswork. It's always a factor.
So, okay, we've unpacked these two pretty compelling but different scenarios. Oil and gas, Nebraska Basin, that intriguing hydrogen whisper in both. From the grand vision for the whole Wolfcamp formation there down to the nuts and bolts of the Purdy Oil Investment Agreement, there's clearly a lot to weigh up.
Indeed. You know, understanding the rocks, the geology, that's step one. But the real work for an investor, that's rigorously picking apart the financials, the legal setup, the team running the show.
Which really brings it back to you, the listener. If you were looking at opportunities like these, what questions would you absolutely need answered to feel confident? Maybe you'd want to see the full geological reports underpinning that Wolfcamp summary. Or perhaps, like we discussed, you'd insist on an independent audit of Purdy oil before wiring any money. Digging into documents like these, it's really just the start of navigating the very complex world of investing in resources.